Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook and your host for about the next 25 minutes here on Options Guide TV. Well, happy 4th, a little belated, but now the markets are back and we're rocking and rolling. It was definitely a long weekend, a very hot weekend over the 4th of July holiday. I'm going to get hot with VIX options, I think. The VIX has came down precipitously recently. And if I look at a chart of the VIX, let's run over to the Trader Pro software. We see that we haven't been down to these levels in quite some time, and we're getting into the July time frame, and sometimes we get a little bit more volatile in August, and obviously in September and October, those have been very volatile months. But I think it might be time to get long some VIX. Now, if we look at the VIX chart, which is the volatility of the options, the VIX options inside the actual VIX index, it's the VIX of the VIX. And we see it go as high as 140, means the options are trading at 140% vol 30 days out, and then as low as 86. And we very rarely get below that 86 level. So let's go out even 1,000 days is forever in the VIX. But if you go all the way out to here, going all the way back to 2024, July of 2024, before you see any sustained moves below 85 in the VIX. Okay, then you come back and you look at the actual VIX index, and we'll keep it that long. So we got the 20-day moving average too, and the 200-day moving average. All the moving averages were below every one of those, and the VIX is usually a mean reverting index. I like to look at the 50-day. I think that that's relative, but if it's definitely below even the 200-day, which is the green line, and I'll zoom in a little bit here, the VIX wants to revert back to the mean. So here's the 200-day moving average. We're below all of them. We might even be below the 20-day. Yep. So we're below everything as far as the VIX is concerned on the moving averages, and it is a mean reverting index. So let's zoom back out and just look at how many times has, like, this was a decent amount of time that we stayed down around the 15-16 level. And that is July going out to September, and then we've kind of moved back. So that's a long period to stay within that range, but that is an anomaly relative to the rest of the chart going all the way back to 2025, basically a year back. And so I think it's worth this opportunity, if you will. Holidays are beyond us. People are starting to look at their portfolios again. They're ready to get into the end of summer, and that's when we usually get to see a little bit of fireworks in the marketplace. So with that said, let's look at the first trade that I have in the VIX, and I'm going to give you 3 different VIX trades that we can work at, or that we can decide upon. And I might actually send all of them to the trading floor. But if you're trading the VIX and you want to, might as well go full screen here, and you want to learn a little bit more about the nuances of the VIX options, and this is your first time hearing it, and inside my profile on x.com at Brian Overby, I have one article in there called Decoding the VIX. Just look at the profile, look at for that article, and that talks about how the VIX futures are so much more important in the VIX index than the actual spot, the actual cash index, the VIX, and that the futures actually trade right along with the option contracts, and they're the true underlying. So if we're going out and looking at all the different expirations in the VIX, I don't like to trade the weeklies at all. They're just a little bit illiquid, but the actual VIX, the VIX that expire on the Tuesday before the 3rd Wednesday of the month, and they do that just because of the way the VIX is calculated, but the true expiration is on Wednesday. And that's when August 19th, 44 days out, it's green inside the Trader Pro option charts. And I want to buy that. We got 44 days out, and we can get long the VIX fairly cheap here, in that the VIX is trading around 16. I think 17. I think that's too low personally. There's just too many still unknowns. Iran is still an issue. A lot of geopolitical concerns. Inflation is still a little strong. AI spend is huge. Everybody's going in debt, including the US government. There's still, the economy appears to be strong, and a lot of it is because of the influx of capital that's coming in because of AI. So there's still some concerns. And of course, the market continues to set new highs. You still need to be in the market. I'm not saying it's time to run, but to get some volatility as we head into the end of the summer, I don't think is out of the ordinary, if you will. So I want to get long some VIX, and I was waiting until we got done with the 4th of July holiday before we started to think about it. We might come back and revisit it again a little bit early. We're talking what today is July 6th, but it also means that there's an opportunity here. So I'm going to do one of our open wing butterflies. If you watch the show, it's one of my favorite strategies on volatile underlyings. The stock is the VIX is at 16. Now it's a cash settled index. So realize that too. You're not going to end up with shares of the VIX, if you will. And we're going to buy the 17 strike call, sell 2 of the 21 strike calls, and then buy 1 of the 22 strike calls. Now this is 4 points wide. This is 2 points wide. And our midpoint right now is 97 cents on it. So this being 4 points minus 2 points means that anywhere above the 22 level, this open wing butterfly should trade for $2. We're paying $1 for it. 44 days out, that means that we can make $1 anywhere above and beyond that. So let's look at that in the profit and loss calculator, the what if calculator, if you will. And we'll scroll down here. And it highlights that, right? Here's where the VIX is at. Here is where the 17 strike is at, all the way up to the 21 strike. That's 4 points wide. The short spread, which helps pay for the long spread, that's the way I kind of like to think of a butterfly, is we stop short on. We didn't quite bring in as much credit, means we got to pay a little bit more for compared to our standard butterfly. But then from then on up, 20, 21, 22. Okay, gosh, we can still get that done. I guess 23 would have been 2 points wide. So we're this is going to trade for able to make $200 on a $100 investment from 22 on up. And the maximum we can make if it goes out right at the strike price, which would be $300 on this trade. It would be trading for $4 minus the $1. That gives us $300. And then we go from 21 to 22. That's only $1. So that leaves us with $2 from anywhere on up from there. I like that even more. So 21, 22. So this should have been the 23. But I like this if I can get this done for $1. So there's nothing on the chains. If we go back to the chains, like we have to go to a 25 strike call to pay $1, 25 or 26. And that takes a real move in down in the markets to drive the VIX to a 25 or 26 handle. Let's run back to the charts and let's grab the 25 area. Like looking all the way back to, this is of last year, the 25 area just doesn't get reached that often, right? The 20 area, we hang out in quite a bit of time. So I'm just froze a little bit, but the 20 area, there it is. Here's a whole grouping of times where we're at the 20 or above, which that's just fine by us. So that's why we're going to charge this 2021 area. That's why we're going to target that area. And if we scroll all the way out even further and further, let's re-zoom in. and we scroll out further and further, there are many times where it's been to 20 or higher and where it's even hung out in the 20 range. So I like the VIX trade here. I'm going to see how much. Well, it would only be a dime cheaper because this bid, I'm just looking at the bid, or we could go ask to ask, I guess. Let's go intrinsic value, the midpoint, 135 to 123. So it would only add 12 cents more. It would cost 12. It would save us 12 cents if we did the 23. So I don't think there's a need. We're still get to sell all the premium of the 21 twice. Yeah, I like this setup a lot. Any questions on the VIX in general? If you have them, do please put them in the chat box. The VIX is a very odd underlying. It's an index. It's cash settled. It cannot be exercised early. The normal expiration is on a Wednesday, and what else are nuances? And the futures, where the VIX futures are at, is what really drives the underlying market. So right now we got the VIX at 16. The VIX future going out to August, 44 days away. We got to go and look at where the put and the call line up is right about. Well, this is one night. It's right about 19. So it's between 18 and a half. 18 and a half should be really close. Yeah, 18 and a half, because the ask here is 212. Well, we'll look at the extrinsic value. That's the midpoint, basically. The extrinsic value here is 208, and the extrinsic value here on the outside is minus 60. So in this instance, we're that's you can't do that because it's using this price. Okay, so 205 and 195. It should be 1850. 1850 is about where the future's at. So the August future is at about 1850. We're putting on this butterfly, centered it around 16, going out to 21 in this instance. If we end up anywhere above 17 plus 1, $18 on this trade, we're fine. It's where our break even is at, is this plus this net debit. And that is also shown in the what if calculator. It should be right about here. That's where we cross the zero line, right at that 18 level. And it's still hanging out around 97, very liquid underlying. I like this trade heading into August. If the VIX goes down, obviously that hurts us. If the volatility goes up as the market goes up, the delta is going to be stronger. The power of the options is going to be stronger than the power of the movement of the underlying price is going to be stronger than the implied volatility move, because we're going to be so far out of the money on a percentage basis, 17 versus 21, 4 points out of the money. So yeah, I like this move. I like this move right here, right at this level. And we're going to send this one down to the trading floor. Let's do the read back. Okay. And I will also go out and I'm going to pull up the CBOE VIX futures quotes to highlight. And if what I just said about the future scared you, once again, go to x.com at Brian Overby and look for my article called Decoding the VIX. And so now I'm going to pull this out just a little bit here. And we will look at the VIX future for that August expiration. So this is the Chicago Board Option Exchange website, which is now known as the CBOE. They got rid of that long word and it's just called CBOE. And if you scroll down, and all I did was typed in VIX futures quotes, and they're delayed futures quotes by like 15 minutes, no big deal. And here is the July future, and here's the August future. So it's 1865. So what we did was called a combination, put call parity, however you want to look at it, to see where the prices are at. So even though the VIX is at 16, The August marketplace is putting the VIX at 1865, which helps us get some of that premium actually, because that's the options that we're selling at are trading at a higher valuation relative because the market is here. This is where the futures is at, and this is what prices the option contract. You go out to September, you got 19. You go out to October, you got 20, and we stay at 20 all the way to the end of the year. That's where the futures are thinking the VIX will go. They think that the 16 is fairly low, and I agree with them, and they expect more volatility going out in the future. So this is the trade that we're going to do. We're going to own a little bit in the money. We're going to pay $1 for this, and I still like it. Still at that price. So with the VIX trading at exactly at 16, we are going to look to do an open wing butterfly. We have the futures for the August 19th expiration, 44 days away, are trading at $18.65. It's where the futures that represent this expiration are at. We're going to go a little bit in the money relative to the futures and buy the 17 strike, go up to the 21 strike and sell 2 of those, and then stop short on the next option contract. And we're going to buy 1 of the 22 strike calls. Standard butterfly means we would go 4 points out and we buy the 24 strike calls. Because we did that, it will cost us a little bit more, but it's going to open up the wing of our butterfly and make us profitable anywhere above 22. This open wing butterfly 1 by 2 by 1 is trading for 97 cents or $97 per butterfly that is executed. And we're going to send this down to the trading floor. Boom goes the dynamite. Order has been sent. Now, if you have any questions, please feel free to put them in the chat box. I like starting to take positions in the VIX going into September and October. We'll probably come back and we'll revisit this again. I find this to be a very interesting trade because we've came down so much on the VIX. And you see the chart. There aren't many times in the history of the VIX that, especially with all the geopolitical concerns going on, that we've seen the VIX actually trade and sustain lower than 16 for a long period of time. It's below all of its moving averages, the 200, the 50, the 20, all of those moving averages were trading below that. Look for some volatility as we head into the end of the summer. We got plenty of time here, and we don't really care if the market shoots up. Now, this isn't a home run trade by any means. We're only paying $1 for it. Don't go crazy on the leverage in this scenario. But if we get the VIX at expiration, it's all cash settled. You don't have to worry about early assignment. You don't have to worry about anything like that because it's an actual cash settled index. If the market does shoot up and we can double our money on this, take it and get out. Don't look at trying to hit the home run, landing it right at 21 and hope that it goes out close to that as at expiration. Because if the market does go up, you need, for a butterfly to pay out, you have to be very close to expiration. So my goal would be to try to make $1 on this. If I can get a little bit more, that's great, but I'm going to close it. Don't get greedy with it. And if I'm down 50 cents, you can get out of the trade if you would like. But I'm going to take the attitude with the VIX that I'm putting this trade on, and I'm not worried to lose the capital that I'm putting into the trade. A very speculative underlying. Now, the other way to play this, and it's a little tough. You have to realize that the VIX right now is trading around $18.15. So I don't mind buying some out of the money call options. I don't mind that at all. And just hope you get the big spike up, because one of the things about the VIX right now is that, and let me scroll down here and go back to full screen again. The VVIX is trading at 89.95, the VIX of the VIX. And that, once again, I'll go back to the chart. So the VIX of the VIX, and it doesn't get much lower than that. It very rarely, like here's the, I don't even remember it being at 73, but 73 is the lowest it's been going back 1,000 days. And more recently, the lowest it's been is around 82. And we're now at 89. So if you're going to buy premium, I wouldn't even mind going out a little bit further in time and going out 72 days, but we're going to have to pay up a little bit for it. And the downside is that the September future is at 1953. We're at 1865 right now. And then we'd be at 1953 on the future that we're paying out 72 days out. Can't really sell the short term against it. Yeah, let's still look at buying some of it. We're going to get that premium. So we'll go somewhere close to at the money, which is the 20 strike, 240. Yeah, let's just buy the 20. And we're going to put this position on too. So we sent our open wing butterfly, but we're going to have to pay for this one. Now, this is very speculative, but you have a lot of time and you're just looking for one big spike up. And I don't like to sell premium against it. A lot of people talk about doing long call spreads, but to me, the VIX is you're looking for the spike. And run back to the chart, a little bit all over the place as far as the charts are concerned. But if you see the spike up and you have a long call spread, well, you're not going to participate. And the thing about the spikes is that they happen and they happen quick. And then you just got to get out. And going all the way back to here, this is at 35. So it's got to, if it's 20, it's got to trade for 15, right? Because it's intrinsically worth 15 points at 35. And then you also get the premium that's involved with it, which would actual skyrocket when the VIX skyrockets. So you're going to get a bump up in VVIX. You're going to get a bump up in the actual movement of the index. So I don't mind buying some longer term premium, and we're going to make that one of our other official paper trades. And we're going to come back and look at that. As far as volatility is concerned, this is some of the lowest implied volatility that you can buy. The VVIX being 30 days out, we're 72 days out here. So I'd have to go look at a futures for 72 days out to try to figure out exactly where that implied volatility is at. But I don't mind paying $2.40 this far out. If you want to get out, if you're down on half, but this is all, the VIX to me is all about that one black swan event, and you buy it and you hold it. And if it does not work out, then you lose what you paid for it. Don't mind if you want to say, if I lose half of it, I'm going to get out. I don't mind that at all. And if you start getting nervous, you can sell some premium against it. In other words, I can buy this 20 and then go out and sell the 25 later on, just in case, and do it as, as we get to August, let's say, we still got 72 days. So we cut that time in half. And now we're at the beginning of August. And we say, well, I don't want the cheesy more, just let me out of the trap. Then I sell a call against it. I do something like that. That's a possible way to do it. There's nothing wrong with legging into it a little bit later. All right, so here we go. VIX is at 1605. The September 16 72-day future is trading at $19.53. We're going to look to buy an out of the money call option. We're just going to look at the 20 strike call option, and we're going to buy that for $2.42. That's where the midpoint is at. And we're just going to remain long a call in that September 16th expiration contract. We're going to send that down to the trading floor. Boom goes the dynamite. And now we have two positions on, a total of $3.40 or $340 approximately, if we can fill at the midpoints of these trades. And we're going to be long a call option and long an open wing butterfly. All right. Any questions? Any concerns? Check out my article, Decoding the VIX, in my X profile, x.com. And that's going to be it for this edition of Options Playbook Radio. We'll be back on Wednesday, and we'll look at some of the positions inside the portfolio, and we'll probably make some adjustments. Our Google long option isn't doing as well as we'd like. We got to probably adjust that or get out of the trade. Still like Google longer term, so we'll probably roll that option contract, and we'll look at some other positions in the portfolio on Wednesday. Thanks for stopping in, and we will see you this Wednesday, 11 a.m. Eastern Time, for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.